Welcome to this Killick Explains video. This week I want to take on a simple rule that every new stock market investor needs to grasp, and something that many older hands sometimes forget. So the background is what? Well, volatility this year, which I cover elsewhere, has tempted many new investors into the market, all hoping to beat it. The problem is, in doing so, they may forget one very simple rule, and that is that most, if not all, of the available information about a stock, or a group of stocks, or an index full of stocks is already priced in. Now, an important reminder coming up. Basically, the stock market is packed with professional investors. It's easy to forget that when you're working from home, furloughed or otherwise, working on an internet forum, discussing something with a mate, or simply sitting by yourself, reading websites, analysing papers. It's easy to forget that out there you are up against bank traders, funds and hardened speculators. Thousands of people all trying to get an edge. And that doesn't leave much room, I'm afraid, for new information. So, a common misconception coming up. Investors are often surprised when seemingly logical assumptions fail to deliver returns because they've forgotten what I just said. Now, there are many examples, but a classic, which people write university theses about and so on, is the relationship between expected growth, measured as real GDP, and stock market performance. You might think, that investing in a higher GDP country would deliver superior long-term stock market returns. Surely, that's a logical inference to draw. No. Now, what I've called an inefficient market study, because it was based on emerging markets where people traditionally think there are information asymmetries, opportunities to uncover information other people don't have and therefore make money exist. So this study was done by Jim Davis of Dimensional Fund Investors over the period 1990 to 2005. And basically, to summarise quite a bit of science here, which is in the original paper, he looked at returns from high growth and low growth emerging markets. So he basically looked at real GDP growth rates and sort of ranked top to bottom and then cut his sample in half to get high growth and low growth. He also looked at two different approaches to high growth or low growth investing, and that's the market capitalization based approach, where essentially you mirror what an index would do by putting more money to work into the larger, more popular stocks, if you like, the more valuable stocks, and less into the less valuable ones, versus equally weighting. Very simply speaking, that would be taking, say, £100, 10 stocks, £10 in each. Now, what did he find? Well, the average annual return was 16.4% for both high and low growth countries on average. So that's quite an important finding. So suddenly, over that fairly long period, the average annual return was pretty similar. And that's because emerging markets, as he put it, do an excellent job of reflecting growth prospects in stock prices, just as do more developed markets. And he also discovered something else along the way. So, an interesting result, as I see it, coming up. The equally weighted average annual return, that's where you take your money and split it evenly across the constituents of a portfolio, if you like, was 22.6% for the high GDP growth countries in his sample, and the equivalent return for the low GDP growth countries, 21.6% on an equally weighted average annual return basis. But you might remember that the number I gave you for the market capitalization weighted approach in both cases was quite a bit lower at 16.4%. So that rather throws into relief the fact that slavishly following an index, many of which are built on a market capitalization weighted approach. In other words, your money goes more into the big popular stocks, less into the smaller, less popular stocks. That doesn't work as well here as simply equally weighting. And the reason's very simple to explain. If you slavishly follow an index, you're almost by definition buying more of the more expensive stocks and less of the cheap stocks. And over the long term, you want to be buying low and selling high. So actually you're being forced into a strategy that isn't optimal, some would argue. So conclusions, and one or two of these I've said already, but let's wrap up with two or three. So first of all, remember that although not perfect, very few markets are perfect. There are frictions, as they're called. There are inefficiencies, there are costs, taxes, and so on. Stock markets are pretty efficient. A global stock market is one of the most efficient arenas in the world, outgunned, if you like, only by things like the forex market. So the only way to beat the market is to uncover new data, and even then there will be a cost. So even if you spend all the time and effort researching, and you think the forecast real GDP rate for a particular economy has been undercooked, you've got information to suggest that. You've then got to justify all the effort you've put into finding that out, and then you would be able to construct a strategy that will take advantage of it at a reasonable cost. And none of those things are easy to do. Final thing to note is that slavishly following a broad index may not maximise your returns, whether you're following a high growth, a low growth path, or something that's a mix of the two. Any questions? editor@killick.com. If you'd like to watch videos on equity investing, then it's killick.com/learn and the shares tab. And equally, you can ping me at this email address if you'd like to receive a copy of my introductory guide on how to invest in equities.